All right, first weekly update of the year. As everyone knows, the first week of every month is the labor market. And the labor market is very important to us because other than inflation, labor is the most important thing that we can analyze from a week to week and month to month basis that can really affect interest rates. So this week, the labor market actually came in pretty hot. We've had about 3 consecutive months of the labor market showing signs of cooling. And even though the signs of cooling are a positive sight compared to like the all-time highs we were seeing in summer of last year, this week we kind of reverse trend and we do have a little bit hotter of a labor market. So first we'll start out with JOLTS, which is basically job openings. Those were slightly lower than expectations, around 8.79 million. Expectations were about 8.8. So all in said, about right meeting expectations. We can still see the trend is down over the course of the past 9 months. This is going to be a very important chart to watch over the next 6 months because if you analyze job openings over the last 5, 6, 7, 8, 10 years, we've had a trend up. But then we had an insane spike down when COVID hit and then an insane spike up when COVID happened. And now it's come back down to that trend line. So we're going to see how this plays out over the next 6 months if we're going to continue this trend, long-term trend up or the short-term trend down. In addition, ADP payroll came out this morning and crushed expectations. ADP payroll has actually been the one that's been missing expectations for the past 3 months. So today it beat expectations by 50,000 job openings, which is a huge number. And of course, jobless claims. We look at jobless claims because this one comes out every single week. And this one to me is actually the most important. It doesn't have the most weight for interest rates because there's so much weight put on JOLTS and non-farm payroll and things of that sort. But jobless claims is actually a great indicator of what future labor market prints are going to be because jobless claims is every single week and it reports how many unemployed individuals are requesting for unemployment benefits. So this one came in very soft, pretty much 2023 lows, around 200,000 jobless claims, which is significant because normally November, December, you actually see jobless claims rise, in January and February as well. So the fact that it didn't rise in December is pointing that we still do have a slightly resilient labor market. With this news, it doesn't point to any type of imminent Fed rate cutting, and that's where we're torn, right? We know the last Fed meeting in December, the Fed indicated rate cuts. They indicated there would be 3 rate cuts through the dot plot in 2024. CME futures are indicating there's going to be 6 to 7 rate cuts. So a big discrepancy between the two. The next Fed meeting is not until the 31st of this month. So we still have major data to come out. We have next week, Thursday, we're going to have the CPI report. So that's going to be the big one to watch. Where will CPI continue to fall? Because that's what the Fed's watching. But this labor market week kind of pointed that, hey, maybe they don't need to cut as quickly. We were absolutely expecting going into this week a 25 basis point cut on the March meeting. As of right now, the percentage is still there that we will be cutting in March, but now the percentage is down. We went from a 75% chance of a rate cut in March down to about a 60 to 65%. So slightly down. Obviously, again, tons of data to come out between now and March 20th. We're going to have more labor market prints, more CPI prints, and of course the Fed tone, the Fed sentiment. What will they be saying? Will they be continuing to relay over that, hey, they're going to remain stable? They want to see more time of this Fed funds rate to work its way through the economy, or are they acknowledging that the economy is slowing? Their tone is going to be incredibly important to watch. But overall, that's where we're at today. So interest rates got slightly worse. Definitely reach out to a secure choice lending loan officer today to kind of check where they're at.